All right, taking the conversation further now. Yeah, the U.S. Fed, as expected, interest rates is held again. And let's bring in Halima Adedirono, analyst, FDC. Halima, yes, this was expected. After that video by the Fed chair last time, the defiance video, I guess nobody was expecting a cut at this point. How are you seeing it?
So definitely, the move or the stance of the Fed aligns with consensus, market consensus, which means the Fed maintains status quo. And apart from that, I mentioned earlier in the week that the forward guidance would really help, and markets are really looking forward to what it would be like for interest rate movement in 2026, apart from the immediate decision. And so the Fed has made it known that there will be a meeting-to-meeting consideration, meaning the interest rate move in 2026 in general will be driven majorly by data, meaning the economic resilience, the labor market conditions, inflation trends are what will determine what the Fed will do as regards the movement of the interest rates. And what does that mean? It means that in the global market, the global capital would stay longer in dollar assets, which means there could be less room for emerging markets to really drop their rates, because it will mean that their what is it called, currency will be weakened. And so emerging markets need to look more into the domestic condition to really improve the economic resilience in total, because given the global outlook is looking like it might, the interest rates in the global market might be more tightened as regards to the financial markets in general. So it means for the global markets, we are going to see more tightening, and domestic or the African countries need to look inward in order to really help their currency and their economic conditions.
All right, so, definitely woke up this morning and we're seeing oil markets, the rallying at this point. I did see in the media there that Nigerian oil, that's Bonny Light, that's nearing $70 per barrel also. So I guess it's Iran that's stoking this.
Okay, so for the oil markets in the beginning of the week, we saw that the price drove downwards, and that is because the market was expecting that the Kazakhstan oil supply would help the price to come down. But going into the week, we are seeing a convergence in geopolitical tension and weather-induced supply shocks. And for the global for the geopolitical tension, we are seeing that markets is responding to fear that the U.S. might launch a military strike on Iran, given that it's trying to prevent it from developing what is it called, missiles, and also because of the what is it called now, the protest that is going on in Iran. So those are the reasons for U.S. wanting to launch that on Iran. And apart from that, we'll see that there is also weather-induced demand, which is causing the global markets to think that there could be a shock when it comes to the supply in the global oil market. So bringing the two together, we are seeing a simultaneous supply shock altogether in the oil markets. And that could mean that would drive the oil price going forward in the what is it called, the global oil markets. And so this trend will continue until we see maybe the weather stabilizing, or maybe the geopolitical tension isn't off. And so for now, we always see this immediate shock when it comes to geopolitical tension in the oil market.
Yeah, so much playing out in the global commodities market right now, and I'm sure some investors will be hitting themselves saying, why didn't I buy some of these metals earlier, in 2024? But thank you so much, Halima Adedirono, Senior Analyst, Financial Derivatives Company. Thank you.
Thank you for having me.